Today, we compare two powerful financial tools for tapping into your home equity. These tools are home equity lines of credit, or HELOCs, and cash out refinancing. Now, are you facing rising debt, planning a major home remodel, or looking for a way to cover unexpected expenses? Today, as we explore these two powerful tools for unlocking the equity in your home, we'll see which one could be right for you. Either home equity lines of credit or cash out refinancing. Tapping into your home equity is not a decision to be taken lightly. So stick around because we're about to explore how these options work. And we'll see why the current economic climate makes understanding these tools more important than ever. But before we dive in, let's quickly define what home equity is. Now, it's the difference between your home's current market value and what you owe on your mortgage. For example, if your home is worth $300,000 and you owe $200,000 on your mortgage, you have $100,000 in equity. Now, this represents a significant financial resource, and it's important to approach it with caution and careful consideration. Now, let's break down these two methods of tapping into that equity. First up, we have the home equity line of credit. Now, this is more complex than a simple credit card. During the draw period, typically lasting 5 to 10 years, you can borrow from your HELOC up to your approved credit limit. You're not required to borrow the full amount, and you can draw funds as needed. Now, this part is similar to a credit card. Now, once the draw period ends, you enter the repayment period. This typically lasts 10 to 20 years. Now, during this time, you can no longer draw funds from your HELOC, and you must repay both the principal and the interest on your outstanding balance. Your monthly payments will likely increase significantly compared to the draw period. HELOCs usually have variable interest rates, and this rate is often based on an index plus a margin. This means your interest rate and your payments can change over time. Now, for the second method, we have cash out refinancing. Now, this is a more complex process than simply trading your old mortgage for a bigger one. Cash out refinancing does replace your existing mortgage with a new, larger loan, but you then receive the difference in cash. Now, how this works. First, you apply for a new mortgage that's larger than your current loan balance. The new loan pays off your existing mortgage. You then receive the difference between the new loan amount and your old mortgage balance in cash. Some of the key features of this financial tool is that you can typically borrow up to 80% of your home's value. Your interest rates are often fixed, providing stable monthly payments. Your closing costs range from 2 to 6% of the loan amount. Repayment terms are usually 15 to 30 years, resetting your mortgage timeline. Now, the cash out refinancing process typically takes 30 to 60 days from application to funding. But here's the million-dollar question. Which one of these is right for you? Stay tuned because the choice between these two options isn't as straightforward as you might think. With the Fed holding rates steady in face of uncertainty, understanding how these options work could be the key to making the right decision for your financial future. As we dive deeper, you'll discover how factors beyond just interest rates can significantly impact which option is best for you. So let's dig into the key differences between HELOCs and cash out refinancing. We'll focus on their unique characteristics and how they might fit different financial situations. Interest rates and market sensitivity. HELOCs typically feature variable interest rates, which can fluctuate with market conditions. This means your borrowing costs may change over time. They may potentially increase or decrease based on broader economic factors. Then on the other hand, cash out refinancing offers fixed rates. This provides more stability and predictability in your monthly payments over the long term. Accessing funds, flexibility versus lump sum. With a HELOC, you have the flexibility to draw funds as needed during a set period, typically the 5 to 10 years. Now, this can be advantageous if you're unsure about your exact financial needs. It can be good if you prefer to access your money gradually. Now, the cash out refinancing, however, provides all the funds upfront in a single lump sum. This may be more suitable for large one-time expenses or debt consolidation. Loan structure and management. A HELOC is usually a second mortgage existing alongside your primary mortgage. This means you'll be managing two separate loans. In contrast, a cash out refinance replaces your existing mortgage entirely. This results in a single, larger loan. Now, this difference in structure can impact your overall debt management strategy. It can impact potentially your credit profile. Closing costs and initial expenses. The upfront costs associated with these options can vary significantly. HELOCs offer lower closing costs. Sometimes these costs are even waived entirely. This makes them potentially more cost-effective for smaller borrowing needs. Cash out refinances, being new mortgages, typically involve higher closing costs. These costs can amount to thousands of dollars. It's crucial to factor in these initial expenses into your decision-making process. Repayment terms and periods. Now, cash out refinances usually come with a longer repayment term, often 15 to 30 years. This can result in lower monthly payments, but more interest paid over time. HELOCs, on the other hand, often have shorter repayment periods, typically 10 to 20 years. Now, this might mean higher monthly payments, but potentially less interest paid over time. Now, understanding these differences is crucial in determining which option aligns best with your financial goals and circumstances. As we continue, we'll explore how these factors play out in real-world scenarios and examine the pros and cons of each approach. Before we do, though, if you're liking what you're seeing, a little like on the video goes a long way towards bringing this information to a wider audience. Now, HELOC pros and cons. The pros for the HELOC include flexible borrowing as needed, lower closing costs, and interest-only payments during the draw period. Some of the cons are variable interest rates, risk of overspending, and potential payment shock after the draw period. The cash out refinance pros and cons. For the pros, it includes fixed interest rates, potential for lower overall interest rate, and single loan management. Some of those drawbacks are higher closing costs, less flexible fund access, and it resets your mortgage term. Now, let me give you a real-life scenario to illustrate each option and how they might be best. So, meet Sarah. She's a homeowner who wants to fund her daughter's college education. The costs will be spread out over 4 years. Now, she's not sure exactly how much she's going to need each semester. For Sarah, a HELOC might be perfect. She can draw funds as needed and only pay interest on what she uses. Now, meet Mike. He wants to do a major home remodel, and he knows exactly how much that's going to cost. He also has some high interest credit card debt that he'd like to pay off. So for Mike, a cash out refinance could be ideal. He can get all the funds at once. It's potentially at a lower interest rate than he's currently paying on his mortgage and credit cards. So how do you decide which option is right for you? Here are some factors to consider. Your financial goals. Do you need a large sum all at once or smaller amounts over time? Your risk tolerance. Are you comfortable with a variable rate, or do you prefer the predictability that comes with a fixed rate? Your long-term plans. How long do you plan to stay in your home? The current steady rate environment affects both HELOCs and cash-out refinancing options. For HELOCs, which typically have variable interest rates, the stable Fed rate means borrowing costs are likely to remain consistent in the short term. However, future rate changes could still impact your HELOC rates. Regarding cash out refinancing, the current steady rate environment means that while rates aren't decreasing, they also aren't increasing. This stability can provide an opportunity for homeowners to lock in a fixed rate if they believe rates might rise in the future. But here's a crucial point. Both HELOCs and cash out refinances use your home as collateral. This means if you can't make the payments, you could risk foreclosure. So it's critical to make your payments on time and borrow responsibly. Take the time to crunch the numbers, consider your long-term plans, and don't hesitate to speak with a financial advisor. Your home equity is a powerful tool. Use it wisely. Thanks for watching, and I'll see you again in the next video.